If you have ever taken a trade off a fair value gap and watched price reverse straight into your stop, you're not alone. In this video, we're diving deep into the core of fair value gaps, what they are, why they form, and how to trade them smartly, not emotionally. We'll start with the basics. What is a fair value gap? The different types of price inefficiencies you'll see on the chart, and the key difference between fair value gaps and traditional imbalances. Then we'll break down the psychology behind FVGs, why price returns to these zones, and how smart money uses them to trap emotional traders. You'll also learn about inducement and how it creates weak FVG setups that most traders fall for. I'll show you how to avoid those traps and focus only on high quality FVGs using my 4-step checklist. Finally, I'll share my 2 favorite FVG strategies, proven setups that I personally use to catch high probability entries with strong risk to reward. If you're ready to stop guessing and start understanding how fair value gaps really work, this video is all what you need. So make sure to focus, grab a cup of coffee, and watch the video till the end. You don't want to miss any of this. I'll see you right after the intro. Welcome back, traders, and let's get right into it. So, what exactly is a fair value gap? An FVG shows up on your chart when the market experiences an imbalanced price move, usually caused by a sudden surge in one direction without any meaningful pullback. These aggressive movements leave behind zones where liquidity was skipped, essentially price inefficiencies, which appear as gaps between candles. These gaps often act like magnets, drawing the price back to them over time. Because of this, FVGs are high probability areas for potential trade entries. Price often reacts after revisiting and rebalancing these levels. And before we go deeper, let's quickly review what inefficient price delivery actually means. There are 3 major forms of price inefficiency. The first one is fair value gaps. It usually forms across 3 candles, where the wicks of the candles on either side don't fully overlap the body of the middle candle. This creates a clear gap drawn from the body of that middle candle. Price often returns to fill this space, making it a critical area to watch. The second form of price inefficiency is volume imbalances. This occurs when there's a discrepancy between the close of one candle and the open of the next. Even though trades happened, the volume is unevenly distributed. These areas can also attract price movement as the market seeks to rebalance. And the third form of price inefficiency is opening gaps, the easiest inefficiency to identify. It appears between a market's previous close and the next session's open, with no candles in between. These gaps are usually filled quickly, making them ideal for short-term opportunities. Within any fair value gap, there are 3 critical price points every trader should monitor: the premium high, top of the gap; the discount low, bottom of the gap; the midpoint, also known as the consequent encroachment. Now you might be wondering, which of these levels carries the most weight and how should you use them? The midpoint of the fair value gap is the most significant because it represents the 50% level of the fair value gap. If price revisits the fair value gap and respects this midpoint, it's usually a strong indication that price will continue in its original direction. For example, with a bullish BC setup, if the price returns into the gap and breaks through the midpoint without any signs of rejection, it often means the bullish imbalance is invalidated and the market is ready to push lower. In smart money trading, 2 commonly used concepts often confuse traders: fair value gaps and imbalances. At first glance, they might seem identical. Both highlight inefficiencies in price action where buyers or sellers were unmatched. But there's a key difference in structure and interpretation. So, let's start exploring the differences between fair value gaps and imbalances. Visually, both concepts appear nearly identical on a chart. They're marked in the same way, and both represent areas in the market where price moved quickly, leaving a portion of the range untouched. For instance, when you see a strong candle form and its wick doesn't reach the wick of the next or previous candle, it creates a gap. This can be considered either an imbalance or a fair value gap. However, if the wicks overlap or touch, no such gap exists. The key thing is that both represent open price ranges, areas where the market didn't spend time, which often become important levels later. Now, this is where the differences come in how we trade them. With a fair value gap, the usual approach is to wait for price to pull back into that zone and then look for a potential long or short entry within that gap area. It's based on the idea that price may react and continue in the original direction after tapping into this inefficiency. But imbalances are handled a little differently. Rather than looking for an immediate reaction within the gap, we typically wait for the entire imbalance to be filled. This means price needs to move through the whole untested range. Once that happens, we expect the market to interact with a key demand or supply zone that lies just beyond it. So in a buying scenario, we'd want to see price fill that empty space completely, tap into a demand zone, and then look for a bullish response from there. As you can see, both fair value gaps and imbalances tend to look the same on a chart. The difference really lies in how you choose to approach them. It's all about preference and trading style. Sometimes, price will tap into a fair value gap and immediately take off without fully filling the zone. In these situations, if you're waiting for the full imbalance to be filled, you might miss the trade entirely. On the flip side, there are times when the price does fill the gap completely, so if you had entered near the top or middle of the fair value zone, you could end up getting stopped out or forced to use a wider stop loss, which could throw off your risk to reward ratio. So both methods have their pros and cons. Personally, I stick to trading fair value gaps. It's a more advanced method, and it's something I've been using for years. Fair value gaps are a relatively new term in the trading world. From what I've seen, they only started gaining attention around 3 to 5 years ago. In many ways, they're a modern twist on the original imbalance concept. So what I'll do next is take you to the charts and walk you through why some traders, however, still favor imbalances over fair value gaps. Before we dive in, it's important to say this. There's no absolute right or wrong approach. Whether you use fair value gaps or imbalances, both can work because it depends on how well you understand them and how consistent you are in applying them. So yes, FVGs can help you enter more trades, but in my experience, those trades come with lower probability and less favorable risk reward. Personally, I'd rather take fewer trades with higher quality like the setup we got from the higher supply zone. What makes imbalances more appealing is how linear and mechanical they are. If I see an open price range, I wait for it to get filled before I act. It's a clear and simple rule, no ambiguity. This is a big contrast to fair value gaps, which can appear all over the chart. For instance, on the way up, you might spot a tiny FVG between two candles and convince yourself it's a good long, but that can easily lead to false confidence and bad trades. With imbalances, it's more structured. For example, once an upper imbalance gets filled, I can then look for the market to target a lower imbalance, like this region to the left. It's all based on mechanical logic, not interpretation. Now let's get into the psychology behind why fair value gaps matter and how price interacts with them from a structural point of view. Zoom into a lower time frame and take a close look at the 3-candle formation of a fair value gap. You'll often see a strong upward push, supported by heavy buying interest and a clear absence of selling. This momentum move leaves behind an unbalanced price area, which is known as the fair value gap. So here's where psychology steps in. Many traders miss that initial impulsive leg and wait for a pullback. They place buy limit orders around key areas such as demand zones, order blocks, or the FVG itself, anticipating price to return. These pending orders create a pool of liquidity inside the gap. Since the market constantly seeks liquidity to fuel its next move, it gravitates back toward this zone. And because the demand outweighs the supply in that moment, price tends to continue upward until it reaches a strong supply zone with enough sellers to restore balance. At this point, the market often begins a temporary pullback. But why does this happen? Because it needs to correct the inefficiency created during the initial move. The price revisits the fair value gap, triggering those unfilled buy orders, rebalancing the gap, and then continues in the direction of the trend with even more momentum. This is what makes fair value gaps so valuable. They're more than just chart patterns. They're zones of liquidity shaped by real market behavior. Knowing this concept gives you a real advantage. You're not just trading what you see on the chart anymore. You're trading based on how and why it forms. If you want more trading lessons, market insights, and live analysis, feel free to join my Telegram channel. It's completely free, and I'll leave the link in the description below. Now let's talk about the fair value gap models and how can we use them. Fair value gaps typically fall into two major models, the classic model and the inverted model. Let's start by breaking down the classic model, which is divided into two main types. The first type is buy-side imbalance, sell-side inefficiency. This type of fair value gap appears during a strong upward price move where sellers had little or no chance to participate. The result is an imbalance, a gap lacking sell-side action. The market often returns to this area to provide a fair opportunity for sellers to enter, making it a strong zone for potential long entries during the retracement. And the second type is sell-side imbalance, buy-side inefficiency. It forms during sharp downward moves where buyers don't get a fair chance to engage. As a result, the market typically retraces upward to offer balanced buy-side activity before possibly continuing lower. Now let's move on to the second fair value gap model, which is the inverse fair value gap. So what exactly is an inverse fair value gap? An inverse FVG forms when price fails to respect a standard fair value gap. Instead of reacting or bouncing, price pushes straight through it. When this happens, the original gap often flips its function and starts acting as a support or resistance level, depending on the breakout direction. This concept mirrors the dynamics of supply and demand zones. Just like how a broken supply zone can become demand and vice versa, fair value gaps can also reverse their roles after being breached. For instance, suppose we had a bearish FVG created by a strong move down, but instead of reacting to it, the price bursts through with two solid bullish candles. In this case, the original bearish gap transforms into an inversed FVG, which now acts as a support zone. When the price revisits this level and respects the midpoint, consequent encroachment, it often continues higher, illustrating how the gap has flipped and is now supporting the upward move. As I mentioned earlier, not all fair value gaps offer the same trade potential. Some setups are far more likely to lead to profitable trades.
Now I want to talk about one of the most important trading concepts, which is inducement. When you combine the power of FVGs with the awareness of inducement zones, you begin to see the market more like institutions do. Understanding how inducement works in relation to FVGs can help you avoid fake breakouts and catch high probability entries with better timing and confidence. So let's start by explaining what inducement is. Inducement refers to the market's tendency to lure traders into early entries by presenting multiple potential buy zones, especially in an uptrend. Often, traders are enticed to enter at the first support level, only to see price dip further, hit a deeper zone, and then move in the intended direction. This early entry gets stopped out, leaving the trader frustrated, but recognizing this pattern helps you anticipate market moves more effectively, wait for better confirmations, and ultimately make smarter, higher reward trades. Sometimes the first zone may be the right entry point, but other times it's the second one. And understanding inducement is the key to choosing correctly. One of the main ways to determine which zone has the higher probability is by analyzing liquidity, particularly equal highs or equal lows. Liquidity represents areas in the market where a large number of orders, like stop losses or pending trades, tend to accumulate. For instance, when several equal lows form near the top zone, they create a support area that attracts the market to dip and sweep that liquidity before reversing. This behavior often turns the upper zone into an inducement zone, a trap for early buyers. So, when you see liquidity sitting just beneath the first zone and above the second, it's a strong sign that the market is likely to break through the first area and fill the second before moving in your direction. In such cases, Zone 2 becomes the smarter, more reliable area to enter your trade. Sometimes, identifying inducement zones isn't as straightforward. Clear liquidity setups won't always be visible. In many cases, both potential zones may appear valid, which can make the decision more challenging. When that happens, another reliable method to determine the stronger zone is by analyzing where the actual momentum or strength originated. For example, if there's a noticeable break of structure to the upside, it's important to look at which demand zone caused that move. If the breakout was triggered from the lower zone, it suggests that institutional buying likely occurred there, marking it as a powerful area. This type of demand zone typically indicates where large-scale buyers previously entered the market at what they considered a favorable price, pushing price upward and breaking previous highs. Because of that, this zone carries more weight and becomes a more strategic entry point compared to the first one. Sometimes the market won't reach the lower zone and may instead react from the higher one, Zone 1. So it's important to know how to identify inducement properly. There are two main ways to do this. First, by spotting equal lows or highs, which often signal inducement zones. For instance, if equal lows form near Zone 1, it's likely just a trap to draw in buyers before price drops to Zone 2. But if there are no equal lows or highs to guide you, then the second method comes into play, looking at which zone actually caused a significant break of structure. The zone that generated a strong rally or drop, especially if it hasn't been retested, is likely where real institutional interest lies. Even if the lower zone still has imbalance left, if the higher zone created the strong move, it could still be the ideal entry. As an example, let's look at the 4-hour NZD JPY chart. Price broke structure to the downside from a recent high, so we're analyzing this leg down to decide the best shorting zone. There are three possibilities: a zone near the top, one in the middle, or the current price area. Since there's no clear imbalance or supply at the current level, we rule that out. Now we compare the top two zones by considering which one likely holds stronger selling pressure. That's how we narrow down the best trade entry. Typically, the zone that caused the break of structure is your main focus when identifying a valid supply or demand area. For instance, in a bearish scenario, you'd mark the last candle before the impulsive drop as your key supply zone, expecting the market to react if it returns there. However, problems arise when there's a cluster of equal highs just below that zone. These equal highs act as a magnet for price due to the liquidity sitting above them. Think of them as targets for stop hunts. In this case, even though the lower zone shows initial selling interest, it may act as inducement, a trap, because the market is likely to sweep that liquidity before reversing. Instead, the more reliable zone is the extreme one at the top of the price leg, where the trend actually reversed and significant sellers stepped in. This upper zone didn't cause the most recent structure break, but represents where buyer momentum failed and institutional selling likely began. So, for higher probability setups, you want price to break above the equal highs, tap into that extreme zone, and then look for short entries from there. This concept of inducement is one of many advanced factors that allowed me to consistently find high probability trades last year and continues to help my students generate strong results. If you're serious about mastering this, check the description for more powerful inducement trading books, guides, and tools to help you avoid falling into the liquidity traps.
As I mentioned earlier, not all fair value gaps offer the same trade potential. Some setups are far more likely to lead to profitable trades. So let's walk through the 4 essential criteria for identifying high-quality FVGs, the ones with the strongest probability of success. The first criteria is FVGs that form within kill zones. Fair value gaps that appear during key trading sessions, like the London or New York kill zones, tend to perform better. For example, if a gap forms during the active trading period of the London or NY session, particularly during the distribution phases, it's often more reliable. These time-based FVGs typically carry more institutional weight and offer higher success rates than those formed outside of major sessions. And the second criteria is FVGs at market structure breaks or shifts. Gaps that appear during a break of structure or market structure shift are statistically more dependable. When a fair value gap forms as a direct result of structural momentum, such as a clear breakout, it indicates strong institutional participation. These FVGs often get revisited before price resumes its direction, creating solid trading opportunities. And the third criteria is unmitigated FVG. A high-quality FVG must remain untouched, in other words, unmitigated. Once price has returned to fill or interact with a gap, it loses its edge as a trade setup. Think of FVGs as single-use zones. After they've been mitigated, they're no longer reliable for entries. However, the way price behaves upon first entering the FVG can give you insights. If price respects the zone and bounces, it's likely acting as support and could drive price toward buy-side liquidity. But if price breaks through and closes beyond the FVG, it flips into an inversed FVG, now acting as resistance, and sell-side liquidity becomes the next likely target. And the last criteria is FVGs positioned at market extremes. Fair value gaps located at market extremes tend to offer the most reliable setups. These areas, either at the top or bottom of a market swing, are far more important than FVGs that appear in the middle of a trading range. In an uptrend, your focus should be on FVGs that form in discount zones, as these typically offer ideal entry points for long trades. Conversely, in a downtrend, prioritize FVGs located in premium zones to identify high-quality shorting opportunities. These strategic levels help maximize your risk-to-reward ratio and align you with the dominant market direction. Now, let's get into the fair value gap strategies I personally rely on, methods that consistently deliver results when executed properly. We'll begin with one of the most reliable FVG trading strategies that pairs the classic fair value gap model with a liquidity sweep, a combination that performs exceptionally well in both bullish and bearish conditions. In a bullish market, this setup activates when price takes out a key sell-side liquidity level, such as the lows of a demand zone, a major swing low, or a cluster of recent lows, and immediately taps into a bullish, untouched FVG. After the gap is filled, price typically makes a sharp reversal and continues pushing higher in line with the prevailing trend. In a bearish context, the logic is the same, but reversed. Price hunts buy-side liquidity, like the highs of a supply zone or recent swing highs, and then reacts to a bearish classic FVG. The key factor in both cases is that the liquidity sweep happens right before the price touches the unmitigated fair value gap. This confluence often results in strong directional movement. Why does this setup work so well? It's not just about chart patterns. The strength of the setup lies in the market psychology behind it. When the market takes out liquidity and simultaneously mitigates a fair value gap, it clears out two major obstacles: the liquidity void represented by the fair value gap, and the stop-loss orders of early position traders caught on the wrong side. So how can we trade this setup? To trade this setup effectively, you need to place your buy limit order at the top boundary of the bullish fair value gap. Target the nearest buy-side liquidity area, usually found above a recent swing high or cluster of highs. Let's walk through a real-world example using the 5-minute chart of GBP/USD. The pair is clearly trending upward with multiple bullish break of structure moves. Suddenly, price dips below a recent swing low, seemingly signaling weakness, but instead of continuing down, it taps directly into an unmitigated bullish fair value gap just beneath the low. This dip performs a dual function. It sweeps sell-side liquidity, and it mitigates the fair value gap. Immediately after this confluence, price bounces sharply and resumes the primary uptrend. Zooming in, you'll notice a new liquidity pool forming just above a freshly created fair value gap. Since all the ideal conditions are in place, liquidity sweep, unmitigated fair value gap, and alignment with the trend, this creates a textbook trade opportunity. Simply place your buy limit at the top of the new bullish FVG and aim for the next clean high as your profit target. Now let's move on to the second strategy, which is trading inversed fair value gaps. We will explore a more advanced and highly effective trading strategy, combines violated FVGs with liquidity sweep patterns to build a high probability setup that aligns with institutional price action. Let me break down exactly how you can apply this approach in real time. Here we have the 1-hour chart on Euro-USD, where the overall market structure is clearly bearish. Price first sweeps buy-side liquidity just above a recent structural high and then fills an inefficiency. Almost immediately, price reverses sharply, signaling a shift in momentum and setting the stage for a potential drive towards sell-side targets. Next, I drop down to the 5-minute time frame to fine-tune the entry. What I'm looking for here is a violated bullish FVG, meaning price failed to respect the gap and broke right through it. This transforms the FVG into an inversed fair value gap, now likely to act as resistance instead of support. And that's exactly what happens. After the liquidity sweep, price breaks beneath a bullish FVG and closes below it. This violation confirms the zone has flipped, creating a reliable resistance area. On top of that, we get a market structure shift, adding another powerful layer of confirmation for a bearish setup. So how can we trade this setup? With multiple points of confluence now confirmed, liquidity sweep, structure shift, and inversed FVG, we can prepare to enter the trade. Just place the sell limit at the lowest point of the inversed fair value gap and target the nearest sell side liquidity on the current time frame. Or go for a higher time frame liquidity pool if you're aiming for larger moves. Now let's see how this trade plays out. Price rises back into the inversed FVG zone, which is now acting as resistance. Price reacts with the inversed FVG and pushes downward. Eventually, it hits the take profit target, completing a clean textbook move and validating the setup. This strategy shows the true power of inversed fair value gaps, especially when paired with liquidity sweeps and market structure shifts. It gives you a structured, rules-based entry model that aligns with how institutions actually deliver price.
So, what is our fair value gap trading setup? Now that we've covered the core concepts, let's move on to the second part of this video, where we break down a structured fair value gap trading setup. This trading plan consists of two major time frames. Higher time frame analysis. This is where we conduct most of our general market analysis. We will examine market structure, identify key levels, locate liquidity areas, and most importantly, pinpoint fair value gaps. Lower time frame entry. After identifying high-quality FVG zones on the higher time frame, we will zoom into a lower time frame to find confirmation signals and execute our trades. This trading approach is not limited to any specific market or time frame. However, a key rule is that your entry time frame must be at least 2 times lower than your higher time frame for better precision. Recommended time frame combinations. Here are 3 time frame combinations you can use depending on your trading style. For example, if you analyze FVGs on the 4-hour chart, your ideal entry time frame would be 15 minutes. Step 1. Analyzing market structure on the higher time frame. To understand the market direction and locate high-probability trade setups, we apply smart money concepts to the higher time frame chart. The key elements to analyze include break of structure, change of character, and liquidity sweep. Bullish scenario. On the candlestick chart, multiple breaks of structure to the upside confirm a bullish trend. However, at a certain point, price makes a liquidity sweep above a previous high. This often signals a possible reversal. If price breaks and closes below a key low, this confirms a change of character, meaning buyers have lost strength and sellers are now in control. Bearish scenario. For a bearish setup, a change of character happens when price trades below the lowest point of 2 consecutive highs. This significantly increases the chances of a trend reversal, especially if the market was previously in a long-term uptrend. By mastering these concepts and combining them with FVG trading zones, we can refine our entries and take high-probability trades with confidence. If the market direction on a specific time frame isn't clear, it's best to move on to another asset. Trading in an uncertain market environment increases the risk of making uninformed decisions, while focusing on clearer trends helps ensure better judgment and risk management. Shifting to a different pair allows traders to find stronger setups where the trend is more defined. Another key aspect of higher time frame analysis is identifying key levels. These levels serve 2 main purposes. They help pinpoint liquidity zones and potential reversal points, which act as our higher time frame targets. When analyzing a chart, we consider traditional support and resistance levels as significant liquidity areas. Equal highs and lows or multiple rejections at a price level often indicate zones where liquidity is concentrated. But why is identifying liquidity areas so important? Liquidity plays a crucial role in price movements. The market naturally gravitates toward levels where liquidity is present, while it moves away from areas where liquidity has already been taken. Understanding this behavior helps traders anticipate price movements more effectively. Additionally, when liquidity is swept before price reaches an optimal trading zone, it serves as further confirmation for a potential move in the expected direction. These key zones can also act as strong rejection points, making it essential to secure some profits before price reaches them. It's also crucial to evaluate how much space exists between the current price and a significant level ahead. This ensures that any trade taken offers a reasonable risk-to-reward ratio. The final step in analyzing market structure on the higher time frame is identifying fair value gaps, which will serve as our trading zones. However, after spotting these areas, we refine our approach by applying Fibonacci retracement levels. If the market is in an uptrend, we focus on fair value gaps located in the discount zone, as they provide better long opportunities. Conversely, in a downtrend, we look for fair value gaps positioned in the premium zone, as they present better selling opportunities. Once we've identified our optimal trading zone, the next step is to wait for the price to enter that area. At this point, we zoom into a lower time frame to look for reversal confirmations and execute a long trade. This is the core idea behind our strategy. Below is the checklist of concepts we apply on the higher time frame. Now, moving on to the second step of this trading plan, confirmation and trade execution on the lower time frame. Once the price enters our trading zone, we need a clear signal that the short-term downtrend is coming to an end, and that the price is likely to reverse upward. To identify this shift, we focus on liquidity sweeps and changes in character. A valid liquidity sweep below a key low suggests that a reversal might be imminent, and if the price then breaks above a key high, it confirms the change in character. Once the reversal is confirmed, we move to trade execution. The setup involves waiting for the price to create fair value gaps on the lower time frame. After identifying these zones, we set a buy limit at the start of the fair value gap and place our stop loss just below it. For risk management, we secure our first target at a 1-to-2 risk-to-reward ratio, where we close half the position and move the trade to break even. The next target is the first significant level ahead on the higher time frame, which acts as our final exit point. Before diving into real chart examples, let's go over two common scenarios traders face and how to manage them. A very small fair value gap. When the identified gap is tiny, the price is more likely to fluctuate around it. In this case, we use a wider stop loss to avoid getting stopped out by normal market movements. A large fair value gap. If the gap is too wide, placing a stop loss below the entire zone results in a high-risk trade. Instead, we can either use a smaller stop loss just below a more refined section of the gap. Enter at the midpoint of the zone to improve the risk-to-reward ratio. This is the checklist of concepts we apply on the lower time frame. Real chart example. Now let's analyze a real chart example. On the EUR-USD 1-hour chart, the market was in a downtrend until we identified both a liquidity sweep pattern and a change of character. These two signals indicated that sellers had lost control and that the market direction had shifted to bullish. In this scenario, we can identify two fair value gap areas, but only the one located on the premium side of the range is considered a valid trading zone. The next step is to wait for the price to enter this FVG area, and then zoom into a lower time frame to look for potential long trade opportunities. On the 5-minute chart, we observe that the price has broken above a key level, signaling a change of character, which confirms the potential reversal. At this point, we identify a new FVG area on the 5-minute time frame. The trade setup involves placing a buy order at the start of this zone while positioning our stop loss just below it. The long-term target will be the next significant level ahead of the price. Example: Gold 1-hour chart. Looking at the gold 1-hour chart, we see a downtrend in progress with fair value gap areas that could provide short trade opportunities. We then wait for the price to return to this area and zoom into a lower time frame to execute the trade. On the 5-minute chart, we identify a change of character along with a fair value gap area. The next step is to place a sell order at the beginning of the FVG zone while setting our stop loss above it. Now, let's see how this trade plays out. Managing losses in trading. As we can see, this trade resulted in a loss. This is a reality that all traders must accept. No trading strategy guarantees a 100% success rate. Even with a solid plan and accurate analysis, losses are inevitable. The most important takeaway is to stick to your trading rules and follow your risk management strategy. As long as you manage risk effectively and remain disciplined, losses will be just a part of the bigger picture. That's it for this session. If you found this guide valuable, don't forget to hit the like button to show your support. And if you're new here, consider subscribing for more trading insights. See you in the next episode.